Joining us now, Lori Calvasina of RBC Capital Markets and Warren Pies of 314 Research. Great to have you both here. Warren, I'm gonna start with you. The fact that we saw such a stark reversal here in the last hour of trading. I mean, at 3 o'clock, the Nasdaq was down something like 1%. We basically finished flat on the day. Is this just end of the month sort of last minute positioning? How does this set us up looking to June?
Yeah, thanks for having me. I would probably say that's the case. You know, there is a lot of reinvestment flow that comes into the market at the end of the month, and we've been in a low volatility kind of environment. And so this is kind of the path of least resistance. That's kind of the message. Market 60% of all months are higher, and May ended up being another one of those months, it looks like. So that's just kind of what's going on. I think as we turn to June, the big news is what's going to happen with the Fed. They've been dovish despite the data, and I think today's data was actually less dovish than the market reacted to it. But I think it's keying off the Fed's posture. So we go to June and we see what the Fed, how the Fed plays the next SEP, in my view.
Okay. Lori, I want to get your thoughts on the markets at these levels right now, because, yes, we've seen a little bit of softness. We've seen some churn in the S&P 500. We finished today higher. We're lower on the week, but we're still up 4.8% on the month. And when you put it in context, before this week, the 5 weeks prior, the S&P gained 5.5% and basically regained almost all of the ground lost in that recent pullback. Fairly valued here, or is there more opportunity to run?
All right, so thanks for having me as always. And look, I think you hit the nail on the head, Morgan. I think we're fairly valued in here. We have a valuation model that lets us assign fair value of the index at the end of the year based on assumptions about inflation, the Fed, and 10-year yields. And that model, the most optimistic scenario I can give you, if I use consensus earnings of about 245, is pointing to just under 5,300 on the S&P at the end of the year. And that's based on a pretty rosy scenario of getting 1 to 2 Fed cuts, some pretty significant moderation on PCE, and some relief on 10-year yields from where we are right now, getting a little bit closer to 4%. And I think there are plenty of people out there who would tell you that those estimates, those assumptions on the macro are maybe a little bit too optimistic. And if we're looking to maybe dial those down a bit, there could be some modest downside risk in the market. I'm not looking for anything major in terms of downside, but it does feel like we just really need to get beyond this Fed narrative, maybe start looking ahead to 2025 to justify higher gains in the market from here.
Warren, I want to go back to something you just said. Some would say the PCE numbers show that we're getting closer to the Fed's target than some feared. So why less dovish?
Yeah, I think it really comes down to base effects as we get into the second half of the year. And so the month over month, we were up basically 0.25% in today's reading. And when you spin that forward, in order to get, so the Fed pegged their end of the year estimate in Q1 at 2.6% on core PCE. In order to hit that number, we would have to print down to 0.15% gains the rest of the year. It's like there's a number we haven't seen in almost a year now on core PCE. So you have to have some belief that there's just going to be the bottom that falls out of these month over month numbers. And I don't see it. So what does that translate to? It translates to a Fed that's going to have to mark up, if they're attached to reality, they're going to have to mark up their core PCE numbers or estimates in next month's SEP. And so if they mark that up to 3%, which implies a 0.2 of a gain every month on core PCE, if they mark that up to 3% exit 2024, can they still justify the 1 to 2 cuts that are consensus in the market right now? I think that's really where the rubber meets the road, and we're going to find out come June 12th.
Okay, Lori, you said I think the market is fairly valued in your mind. What's the lesson then from Salesforce and MongoDB? And I mean, Salesforce pretty strong into the close here. Did the market learn whatever the lesson was?
So, look, I can't comment on individual companies, John, but what I will tell you is that when you're at a market that's really, just sort of, I don't want to say price for perfection, but something close to that, there's really very little room for error. And when we think about the secular growth trade and how strong some of these growth segments of the market have been, and when we look at valuations, that is really where there is no room for error. And I think, one of the stats that I talk to my clients about a lot is that if you look at the top 10 market cap names in the S&P, have been trading around, depending on when you update the data, like 25 to 28 times forward earnings, kind of bumping up against pre-COVID highs. The rest of the market's trading a little bit above average at around 16 times forward earnings. I talked to a lot of investors that even if they like those secular growers and they're not necessarily dumping them, that they're looking to the rest of the market saying if the economy continues to hold in, that there's just a lot of stuff out there that looks like a better bargain right now.